This presentation uses the historical simulation method to estimate value at risk. I'm Pat Obi, Professor of Finance at Purdue University Calumet. So let's go there real quick, right here on spreadsheets. In this example, we consider a portfolio of two assets: Vanguard 500 Index, symbol VFINX, a diversified mutual fund designed to mimic the Standard & Poor's 500 Index, and Kellogg, the cereal company. Now suppose we invest $700,000 in Vanguard and $300,000 in Kellogg for a total investment of $1 million. Now what we do is we go into some database and pull historical prices for each of our investments, preferably from a recent period. Our sample in this example consists of daily prices from April 2014 to April 2015. So if I go here to the bottom of the file, you see the beginning of the series up to the top of the file ending April 20th, 2015. So with these prices, we then calculate the daily returns, which is what you see right in this column right here, using the logarithmic form, of course. So for example, right there, I'm using equal ln, you open parenthesis, click on current price divided by preceding day's price, close parenthesis, and hit enter. And then you copy down, do ditto for Kellogg stock. So now the idea with historical simulation can be summarized in this way. Given our current investment of 700 in Vanguard and 300 in Kellogg, if we experience the return on, say for example, April 27th, this portfolio would have lost, if you work your way right here to the right, $3,472. Similarly, if we experience the outcome on April 21, our portfolio would have lost 4,319. And in some cases, of course, we have positive outcomes. So to do this, for each of these historical returns, we would calculate their dollar return equivalent. So that right there, if I may delete this, all I did there was to say, okay, suppose we experience the return on Vanguard for April 20th, then the outcome of our portfolio would be, you click on this 0.29% multiplied by 700. And that's how you get that. And then you do the same for Kellogg, and then copy it down so that each day's return is multiplied by 700 and 300 respectively. So in effect, the historical VAR method assumes that the future performance of our investments will follow the same pattern as in the past. Hence, we can use historical performance to simulate future outcomes, which is basically what we are representing in this column for the portfolio, where these two numbers are added to get this. So these two are added to get this. So these are weighted average returns, dollar returns, because they are individually weighted by how much money we put into each of the assets. So this portfolio that we see here, this column we see here contains a series of simulated portfolio gains and losses, which we can actually plot on a frequency histogram, and that's what I did here. So to get this output right here, all I did was go to data, data analysis, histogram, click OK, and then follow the prompts to plot the frequency distribution of the portfolio. And then if you highlight these two columns, you can also get the histogram constructed in a line graph like this. So you highlight them and you go to Insert, To make this quick and simple, you could choose click on recommended charts, and then I chose this first one right here. All right, and then you get this output that you see right here. So you can see that the peak of the distribution right here, which also approximates the mean, is about 0. Obtaining a mean of 0 when daily stock returns are in use is common in financial time series. Now though, suppose we wish to find the 99% confidence value at risk. What we do is to look for the cutoff point on the left of this returns distribution, bearing in mind that going to the left is going into the region of losses. So we look for the cutoff point, as I've demonstrated here, on this distribution, such that 1% of the returns observations are to the left of it and 99% are to the right of it. So the little space out here under the curve is 1% of the distribution, and on this side lies 99% of the distribution. So this point that you see here, which I've represented using this red line, is actually the 99% value at risk based on our historical simulation. Now notice that this 1% VAR question is actually finding the first percentile of the distribution, because the first percentile of a distribution would be that value below which lies 1% of all the observations, above which lies 99% of the observations. And we can actually calculate this directly by using the percentile function on Excel, like so: equal percentile, open parenthesis, highlight all of these values, and looking at the formula up here, what you do is to put comma. You can see me putting comma right there, and then you type 1%. All right, you're going to type 1%, and you can also see right here, type 1 and percent, close parenthesis. I hit enter, and then I go back up here. That's it. So I already calculated it before right here. So if you want it to be the 5% value at risk, then simply change that to 5. So percentile, get this array. All right, I'm going to scroll back up so you can see the source right here. Then looking up there, comma, and then I type 5 and percent and close parenthesis. That's it. So it tells us that 13,356 would be our worst case loss, and we are 95% confident that the actual loss would not exceed it. So if you want this to be the 0.1st percentile, a quick way to do this is hit F2 and just change this to 0.1%. And that's it. So here, this is a 99.9% confidence level value at risk. So again, our value at risk answers the question, what's the most we can lose? In this example, in a given trading day, based on a 99% confidence level. And over here, based on a 99.9% confidence level. And this concludes this presentation. I am Pat Obi, Purdue University, Calumet.